Good morning, hello and welcome to Opening Bell. You're with us on Money Control and I'm Surabhi Upadhyay. It's the start of a brand new week, Monday morning. And the question that we're asking is, will bulls manage to recover from the blows that they received last week? It was all about the big global IT sell-off. It took our indices down to levels below 25,500 on the Nifty. Well, we've got lots to cover today. There are some fresh regulatory updates that we need to be keeping in mind as well. Whether it is stockbrokers, whether it is exchange-traded funds or banks and the kind of capital market exposure they can take. So plenty of regulatory action to track. Many stocks in news. Let's get started with the headlines. Stocks on Wall Street closed Friday's session on a mixed note as key consumer inflation report came in slightly softer than expected and it failed to spark a substantial rally. The Dow gained nearly 50 points, the S&P 500 ended flat, the Nasdaq was slightly lower. Markets in Asia trading slightly lower, tracking weak cues from Wall Street. The GIFT Nifty is indicating a flat start for Indian equities. Crude oil prices record their back-to-back weekly declines this year as investors await second round of US-Iran talks, which are likely to take place on Tuesday. Meanwhile, gold rises to above $5,000 an ounce, extending its rebound on the back of a soft US inflation report. The RBI finalizes rules for banks to finance mergers and acquisitions, with the rule coming into effect from the next fiscal year. Under the new framework, banks can finance up to 75% of the acquisition value, and the acquisition finance will be available only to companies with a minimum net worth of 500 crore rupees. Alongside this, the central bank has also revised rules governing loans against securities, which means that banks can lend against shares, mutual funds, ETFs, and REITs. Two new listings today. Shares of Fractal Analytics, first Indian pure-play AI firm, and MSME-focused NBFC firm iFinance will debut on the bourses. The 2,840 crore rupee IPO of Fractal Analytics was oversubscribed just about 2.6 times. iFinance's 1,010 crore rupee IPO was subscribed 97% by close. Okay, well, and of course, it was an ecstatic victory for the Indian cricket team as India defeated Pakistan by 61 runs in the T20 World Cup yesterday, qualifying their spot in the Super 8 stage. India will be playing their first Super 8 game next Sunday. Okay, indeed, it was a thrilling Sunday for sure, thanks to the boys in blue. A great match playing out. But the match between the Bulls and the Bears is what we'll focus on right now. So let's quickly recap some of those cues. Now, Friday left us none the wiser as far as Wall Street action is concerned. The US CPI inflation print was softer than estimated. That triggered, a bit of a sluggish move on the dollar. It triggered, obviously, a bit of a drop in yields as well. Precious metals gained about 2 to 3%. The US indices, the Dow, the S&P 500, Nasdaq, all of them ended absolutely flat after that CPI report came out. January consumer price index in the US up 0.2% month on month and 2.4% year on year. Both of those numbers were slightly below estimates. As I said, the yields were lower after this data came out. The US 10-year yield settled in around 4.05%. The dollar was range bound. Oil prices, by the way, that's the good cue for us here. Oil prices have now again cooled off a little away from the $70 mark. They've come to about 67. This is on reports that OPEC could perhaps start increasing production again later this year. Also, of course, remember, lots of talks in focus of Russia and Ukraine get back on the peace talks platform in Geneva this week. And then, of course, the US and Tehran talks, they're in focus as well. The key question really is, what will our markets do today? Is the worst of this AI sell-off, is that over or not? Asia is quiet. A lot of the big markets in the region like China are actually shut. We had the Japan Q4 GDP numbers come out, very, very minor increase, 0.1%. But at least it takes away from the contraction we saw in Q3. So keep that in focus as well. Now, the question is, was Friday the end of this brutal sell-off? Remember, the India VIX was up 13 to 14% on Friday. The Nifty broke below its 20 DMA. The index, of course, fell below the 25,500 mark as well. And lots of selling. Foreign institutions selling cash equities worth almost 7,400 crores. Domestic institutions were offering some buying support. They bought stocks worth about 5,550 odd crores. Today, watch out for capital market stocks because of what RBI has said. They've tightened the rule for stockbrokers, and we'll give you more details on this as we go along, but that's going to be one space that's in focus. Let me quickly get to my guests then. We have Vishnu Kant Upadhyay, Assistant Vice President Research and Advisory at Master Capital Services, joining in, and Deven Choksey, Director at DRChoksey Finserv. Gentlemen, thank you so much for being with us on Money Control. Great to have you in. Before we talk about the overall setup, Deven, I want to start with this whole news that came in from the RBI on capital market exposure for banks, specific provisions for brokers. Let's actually start right there, because Friday was pretty packed from a regulatory action standpoint. What did you make of the announcements, and what do they really mean?
Yes, Sylvie, good morning. Well, essentially what it means is tightening the liquidity aspect, I think, which is being provided for the prop trading in particular. And probably, I think they are asking for 100% collateralization, which means that any security, I think, which was up till now being seen as a 50% cash, 50% kind of a FD and other margins, I think is now being taken out, and 100% kind of a collateralized security has to be provided. That's what I think they are saying. Now, what it would mean, definitely, I think it is going to curtail excessive amount of trading activity, which otherwise happens on the counter through the brokers who are basically using the prop desk. So that is one area which is immediately getting impacted. However, one is not fully clear about, I think, whether the banks and NBFCs are included together. Currently, the guideline talks only about the announcement talks only about the banks and not the NBFC. In case NBFC is allowed to do funding, then what could be the caveats? I think we do not know at this point of time. But yes, overall the intent is fine. They want to, I think, curtail the excessive speculation and banks' exposure to the speculative activity. That is what their overall intent is. It may certainly have some impact on the trading volume, because many of the low arbitrage products, which are getting the leverage funding from banks today, including the cash futures or even for that matter index products, arbitrage products, those products could possibly have relatively higher impact on the trading part of the volume. But let's see how exactly the rule gets played out. It is getting implemented, I believe, from 1st April. That is, I think, coming next quarter.
But largely speaking, does it impact Deven all stockbrokers equally, or does it impact smaller brokers more? And to what extent does funding get tightened up? I mean, will the impact depend on the size of the book?
Yeah, the whole idea is basically to curtail the excessive liquidity. So obviously, I think the size of the book gets curtailed. And if you rightly alluded, the smaller book brokers, I think, are going to have relatively more challenge, because they have limited ability to raise money. And that's where probably, I think, the trading volume will get curtailed. That's our viewpoint. In my viewpoint, I think this particular game is theoretically, I think, being shaped out or played out in a manner where I think the big brokers are given a little bit more preference at this point of time, so that I think the market can be properly controlled through them. They are probably, I think, better governed compared to the smaller ones. That is what I think you all understand. And that's the reason the RBI is also, I think, pitching in along with SEBI, want to curtail the excessive speculation. Maybe the directive must have come from North Block, in my understanding, where both the regulators are putting their efforts in order to curb the speculation. Budget has already made the announcement. Now the regulators playing their role by way of implementing policies.
Okay, all right. Deven, just stay on. I have lots more to discuss. Let me quickly go across to Vishnu Kant Upadhyay as well. Vishnu, morning. How are you reading the setup today? I mean, overall, this is one separate story, and we'll talk about capital market stocks and stockbrokers and exchange stocks. But overall, I mean, it was such a tough week for the market, with the Nifty just drifting lower and lower. Where are the supports, and what would your trading advice be for today?
Hi, Sylvie. Very good morning. Well, so we are likely to see a very muted opening for today. But if we talk about positional and the short-term structure of market, so definitely positional structure is still bullish, because prices are still holding above 25,350. In past multiple times we have seen prices taking resistance in the zone of 25,350, and this time when market is falling, this area will act as a very crucial support. Well, so market is currently trading above this demand area, So definitely positional structure is bullish as long as prices are trading above 25,350. But yes, in near term, due to turbulence in the IT stocks, there will be some sort of selling pressure in a very near term. We can say in intraday and for tomorrow. And from higher levels, we will continue to expect some sort of selling somewhere around 25 580 sort of levels on intraday chart. This area has made a very stiff supply area. So I believe as long as prices in short term are trading below 25 580, we will continue to see a selling pressure. But on a broader time frame, the texture of market is still bullish with the validation of 25 350.
Okay, so you'll be buying the dip basically, Vishnu, right?
Yeah. For positional purpose, I would prefer to buy from the lower levels.
Okay, all right. Deven, now let's talk about the market overall, right? This whole IT missile came from nowhere. I mean, this kind of selling on the IT side of the market. And then sentiment was broken across the board. I mean, the way midcaps collapsed on Friday. What's your sense? I mean, is the worst of it over? IT recovered from the lows. At least there was some recovery in IT stocks. But the market sentiment for the rest of the market seemed very weak. Where are we now? Q3 earnings are over. Prices are where they are. What do you make of the overall structure market?
So I think it is understandable that the IT stocks weaken, and as a result of which I think weight balancing activity took over. And as a result of which, I think most of the promising stocks, otherwise which are strong, fundamentally strong companies, they also, I think, got sold off in the market because of this technical reason. In my viewpoint, I think these fundamentals are extremely strong today. You look at, I think, most of the businesses, be it in the manufacturing side, be it in the commodity side, I think the fundamentals remain absolutely very strong and convincing. In fact, I think the budget is possibly opening up a lot more possibilities on this count. So to my understanding, I think this correction which has happened in the market, which is more technical in nature, could invite buying. Coming to IT, my pure understanding says that I think the demand for software is only going to increase with the higher amount of employment of AI. Certain processes which have been carried out manually, I think those processes are getting collapsed, and I think those processes are getting covered by the AI. In our understanding and discussion with majority of the IT companies, including the ones which are providing the embedded solutions, they are very clear about few things. They believe that I think on one side, we are not going to be charging our customers on the time and effort basis. But on the other side, we are being allowed to charge to the customers on outcome basis. Now, if this is a change which has come because of the AI, that means the outcome is expected to be produced, I think, on a faster basis. And that's why customer would be engaging those companies which would provide them the faster outcomes in a way in which I think they would be providing the solutions to the customers. So I don't see, I think, that kind of an impact which the market possibly is saying today. Yes, some of the companies which have not been focusing significantly on the AI front in form of coding, in form of consulting, they may probably, I think, have relatively higher amount of challenge. But those companies which have adopted these practices in their work environment and their way of working, in my viewpoint, I think they should be better off. So let's wait and see. But I think we are not writing off Indian IT companies. We believe that I think they are probably one of the best positioned as far as the AI-related demand is concerned in the global markets.
Okay, all right. So not writing off IT just yet. And Deven is saying that perhaps they are offering some selective opportunities as well. Gentlemen, I'll quickly run through the list of stocks that we should keep on our radar today, the stocks in news for the day. And now earnings season is over. There are lots of stocks beyond earnings as well. So let's quickly get our viewers up to speed, almost coming closer. 5 minutes to go to 9 a.m. So here are the stocks. Manappuram Finance is going to be one of the big headlines to track today. The firm has got the approval from RBI for Bain Capital's proposed acquisition of up to 41.6% equity in the company. Remember that Bain had entered into an agreement with Manappuram back in March 2025. At that point, Bain was looking to acquire 18% through a preferential allotment of shares as well as warrants. And then that was to trigger an open offer. So if the open offer is fully subscribed, then Bain's shareholding in Manappuram will go up to almost 42%. So keep that on the radar. Religare Enterprises is the next stock. The board has approved the demerger of Religare Enterprises and Religare Finvest into two independent listed entities. And Religare Finvest or RFL will issue fully paid up equity shares to Religare Enterprises shareholders on a 1:1 basis. So this is the new structure, two separate individual listed entities holding the two different businesses. That's the story on Relicare. Ashoka Buildcon has won orders, 410 crores worth of orders from the Ministry of Public Works. This is for construction of road projects. Natco Pharma has received an approval from the Central Drug Standard Control Organization, CDSCO, for semaglutide to be manufactured and sold here in the Indian market. Signature Global, RMZ will be acquiring 50% stake in one of the company's subsidiaries for a consideration of just under 1,300 crore rupees. This is for a project in Gurugram in NCR. Lodha, another real estate firm in focus today. Lodha has signed a share purchase agreement to acquire up to 80% stake in Soul Rise Realty. This is a Pune-based company, and Lodha will be, spending about 294 crores for this. Fortis Healthcare came out with numbers, Q3 numbers, steady quarter. Revenue was up about 17.5%. Profit was, however, lower, 22%, largely because of the wage cost impact. EBITDA was up 35% and margin continued to improve as well. The margin this quarter has climbed above 22%. Finally, Ola Electric. Here the losses continue. They've narrowed on a year-on-year basis, a net loss of 487 crores versus a loss of 564 crores. Revenues down 55% year-on-year. The adjusted operating EBITDA loss is at 323 crores. So those are some of the stocks in news. And IRB Infra profit is down about 96%. This is because of the new labor code impact. Revenue is also lower, so not a great quarter for IRB Infra, down about 7.5%. The board has, by the way, approved a 1:1 bonus issue as well. So these are some of the stocks in news. Deven, I just want to come back to the gold financier stocks because so much is going on. I mean, on Friday it was all about Muthoot and this 11-12% decline in the stock. So tell us what you thought of the numbers and the commentary. Was there anything worrying in Q3? I mean, otherwise this kind of a price destruction. And the other one, Manappuram. I mean, Manappuram is going through complete change and Bain is going to be the new promoter now.
Well, I think the current environment with the gold finance companies, they are finding little amount of reluctance from the customers to participate in the higher price of gold. And that's where probably, I think the borrowing part is not happening as much as I think otherwise it would have happened. That is a small understanding which we are carrying at this point of time. In case of Manappuram, definitely I think this particular transaction of close to around 4,400 crores of rupees coming into the books could improve systematically their capital adequacy ratio. And that should allow them to expand their loan book in a little better manner than what up till now they have been having. Though if you want to consider that, I think the previous 6 months in the gold business have been an exceptional period for most of the companies. Maybe I think the next period is going to be seeing more amount of adjustment in the gold price. And that's where the lenders would be slightly more careful because of, I think, the possibility of correction in the gold price. They may not want to lend aggressively at this point of time. So maybe I think we'll have to wait and see how exactly the consumer behavior plays out in this period. Generally, they believe that I think at the time of Dulati, you should be buying gold and accumulate. And I think sales during the time of Dhanteras, though I think the consumer trade is always reverse. But the fact remains that I think if you do that, then possibility of I think you buying gold at a lower price, I think that is always possible. So let's see how exactly this is playing out as far as this year is concerned, because we are already starting on a higher base of gold anyway.
Okay. By the way, we should start flashing the pre-open rates. The Nifty is off to a cautious start in the pre-open session. The levels that we are seeing right now are actually below 400 as well. In fact, 25,340, 337. So the indicative start is that we will lose another 0.25% as things kick off today. And then the question is whether the buyers come in, something that our guests are also pointing out. So yeah, there you go. The struggle and the fight right now is pretty much around the 25,400 mark. Let's pull up some of these stocks. Let's get Manappuram, Muthoot back on the screen as well to see what they're doing. And of course, we need to watch out for all the stockbroker names as well because that is pretty much where the action is likely to be centered today. Names like Angel Broking, names like Motilal Oswal. Okay, we're yet to get rates on Muthoot Finance, so that's taking some time. Let me see in the meantime what we are getting on the Nifty. The Nifty is still struggling around the 25,500 mark, at least for the time being. Let's wait for this. Okay, so Angel One, you saw some rates there, but that seemed a little freaky. 10% lower. Motilal Oswal 1% up. So let's wait for it to settle, and then we'll come back and review some of these stocks. Vishnu, now you're saying you're going to be buying the dip. So is this the kind of level to get in? 25,400. And also, what would your take be on a lot of these capital market stocks that are likely to at least start off on a weak footing today because of the regulatory action?
Well, so definitely having said that, 25,350 is a very crucial support area, and below which we will definitely see 200 exponential moving average that lies somewhere around 25 to 20, 25 to 40 sort of levels. I would prefer to follow wait and watch strategy, as I'm just witnessing on the screen that prices are fluctuating very with a high volatility. So definitely, I would prefer to stick with my view 25,350 for a positional buy, and for a intraday selling from the higher levels will remain unimpaired. As you mentioned, capital market stocks. So until Friday, all stocks were looking very rosy, like GM Financials, like CDSL. But yes, as there is some fundamental headwinds in the market, so definitely these stocks will not remain on my radar for at least today's trading session. So because some fundamental sellings could be triggered in these stocks. So definitely in these capital market segment, I would definitely prefer to follow a wait and watch strategy.
Okay, and what about IT, Vishnu? What would your advice be on the likes of frontline IT, even midcap IT, because everything was slammed last week, including names like Coforge, KPIT, everything was down.
Yes, well, so should be in today's trading session we might witness some sort of short covering in IT pack. In morning I was seeing that ADRs of Infi and Wipro were trading in green. So definitely, but yes, selling positional selling will remain on place in IT stock. So for positional buying, definitely I will not recommend. But yes, for intraday, we might expect some sort of short covering in Tech Mahindra and LTIM kind of stock. So buying can be done for intraday purpose, but for positionals, stay away from the IT counter as of now.
Okay, understood. Got that point. Deven, what is your summary from the Q3 earnings season? What stood out? I mean, what were the pleasant surprises, if any one or two companies come to mind, and where does it leave us in terms of now looking at FY27 earnings?
Yes, absolutely. I think some of the compilation says that I think leave aside the excess provisioning pertaining to labor code in many books. I think leave aside that part of it, because that could be, I think, the impact immediately in the books. But overall, we believe that the growth programs, most of the companies are talking about that the higher amount of growth continuing in next 4 to 6 quarters, particularly companies which are in manufacturing sectors, which are connected with the government infrastructure programs. Those companies are absolutely very confident about delivering in next 4 quarters as far as I think their order book is concerned. So earlier, I think that the risk was on execution part, but at least I think from this commentary that we are listening from some of the capital goods players as well, they believe that I think the delivery would be I think much smoother in next 4 to 6 quarters. So certainly it is opening up FY27 with a great amount of confidence. The consumer companies also simultaneously, top line growth is I think being seen. In fact, I think little surprise was also on the front of some of the FMCG companies, which could maintain the margin or increase the margin by some decimal points. And where we found that I think they are adopting the AI in their supply chain and the logistic, which is giving them the margin advantage as well. So to a greater extent, there is a promise lying here that the higher amount of growth could be seen in profits along with the revenue. Tier 2, Tier 3 for FMCG company and FMEG companies have been relatively much better compared to, I think, the metros, as far as I think the market uptake in the demand is concerned. So that also, I think, has been a little bit more promising. And given the kind of lower interest rate regime that we are experiencing, the banking and financial stocks are confident of meeting their liability side in a much better manner than what probably they would have been. So from a perspective of looking at the higher amount of need, along with, I think, the NII growth, I believe that majority of the banking and financial companies are also right in shape at this point of time. So overall, earnings season has been pretty satisfactory. Leave aside a couple of, I think, surprises on the negative side.
Okay, that's the earnings synopsis as Deven sees it. Just Vishnu, just some stocks quick fire. Let's look at BSE in particular, and I'm going back to the capital market space because that's going to be in a lot of focus in the morning. So on BSE, what would I think we had a close around the 2800 mark. No, not BSEL, BSE we should get. What would the trade be, if anything at all, and where are the supports?
Well, so a technical structure is as of now is looks little rosy, because prices are trading above the cluster of all key moving averages, be it a short-term moving average, be it a long-term moving average. But yes, this news will leave a negative impact on the market, and prices will find a support somewhere around 2880. So as having said that, technical structure is bullish. So with the validation of 2850, one can go long in the stock on fall around 28880 sort of levels. On the higher side, we are expecting a gain of around 3200 levels.
Okay. BSE, as we can see in the pre-open, is down about 7%. Grow is down about 3.5%. Motilal Oswal is down about 2.5%. And Angel One, last I checked, was down 6%. Angel as well, Vishnu. Any supports, any advice on Angel One? We're looking at levels of around 2530 on Angel this morning.
Yeah, so Angel support comes around 2570. If prices topples below this level, then next support aligns around 2420. So definitely, as of now, there is no trade in angel broking. Let the prices come down towards that level, and definitely we will form that strategy where whether we should go long or short in this stock.
And finally, just one more stock from my side, and then I want to ask you about your trades today. Muthoot, given the price damage on Friday, where is the now stock? Has it stabilized? Is it a buy on dip? As someone who's not looking at an intraday trade, is there any point venturing in from a positional perspective on Muthoot?
Yes, despite witnessing a sharp fall of around 11% on Friday, technical structure remains bullish because prices are still trading over its recent swing high that aligns somewhere around 3450. Apart from that, it is also decisively trading about 200 exponential moving average. So prices are continuously forming higher highs, higher lows kind of pattern. So with the validation of 3450, definitely the structure will remain positive in the Muthoot, and I would recommend keep accumulating on the stock on every file. And for positional buyers, definitely prices should maintain above 3200 for positional buyer, and every decline close to that level 3400, 3200 sort of, there will be a definitely buying opportunity in Muthoot Finance.
Okay. So, Vishnu, finally, your trades now. We've thrown lots of stocks at you. But, tell us also if on the bank Nifty, if you would, venture into a trade, and otherwise stocks for today.
Well, so my stocks will be from PSU Bank, and that is Union Bank of India. So after witnessing a very stellar move in the counter, prices are now currently, just consolidating in a very thin band of around 183 on the higher side and 172 on the lower side. And I'm expecting there should be an explode on the higher side, and prices are now all set to, take a leap towards 190, 195 sort of levels. So definitely there will be Union Bank of India for positional buying. Maintain stop loss below 171, while on the higher side 195 will be on card. But for an intraday purpose, I would prefer to bet on a Z Entertainment Limited.
Z Entertainment for intraday. Okay, got it, Vishnu.
Yes.
Thank you very much for all that analysis and the trading calls today. Deven, I just want to discuss financials. We discussed the gold financing companies, of course, but within financials, give us the 3-4 names on which you have a lot of positive conviction looking at the Q3 performance and the earnings trajectory going forward. I mean, do you have a preference in terms of large banks versus, say, NBFCs like a Bajaj Finance? What kind of names would you advise keeping in the portfolio now?
Yeah, I think you rightly said Bajaj Finance. I think very differently they are operating this particular company. They have added fintech, I think, such a powerful way that today 10% of the loan in this quarter, after having implemented the chatbots, they have been able to secure through the AI way of functioning, which means the promises that underlying delivery would be much faster. At the same time, the cost would be much lower in acquiring the customer as well as extending the loan to the customer, and that too in efficient manner. So both Bajaj Finance and Bajaj Housing Finance, I think they look relatively more promising in a given situation. Both of them have been clocking the higher amount of growth compared to their peers, including in the banking space, largely because of the fact the superior ability to lend. In case of Bajaj Housing Finance, I think the portfolio of loan, I think is basically covered in the four different areas. Of course, around 50-55% comes from the mortgage loan, which is your typical housing infrastructure business, where the NIM is 2.5%. But other three areas, which is almost 50%, are the lease rate discounting, lease loan discounting, the loan against property, and the developer finance. Each of these areas, they are generating significantly higher amount of need for them because they are lent at a higher price. So from a perspective of looking at this company, it is basically earning a blended NIM of around 4%. And at the same time, they're clocking the revenue AUM and the revenue growth at around 21 to 23%. So in my viewpoint, I think this is clearly a differentiator as far as the business is concerned. Some of the large banks, I think, still are not fully adapted to the AI way of working, which the smaller NBFCs comparatively. Bajaj Finance, of course, you can't call smaller NBFCs anymore now, but I think that definitely, I think they're growing at a much healthier pace as I see it.
Deven, before we let you go, since you mentioned AI, we have an AI listing today, right? Fractal Analytics. What did you think of the company, the business model, and the price at which they're coming to the market?
Well, it is sounding promising, obviously, from the business perspective. I think, and I'm not too sure about the pricing and the valuation and sustainability. Maybe over a period of time, I think we'll develop more conviction in this particular model. But otherwise, I think it, on the face of it, it is sounding quite promising as far as the solution ability that this company has provided for the rest of the industries that to whom they are catering to.
Okay, all right, Deven. We'll leave you now to get off to the day, and hope you have a fantastic Monday. Thank you so much for joining in. And with that, we are down to the opening bell. So let's see what is the Nifty up to. It's a cautious start. It's a quiet start, about a 0.25% lower, which is what the pre-open session was indicating. 50 points down on the Nifty at this juncture. Look at the Nifty Bank, very similar to the Nifty. Looking at the mid-cap index at this point in time, which is down more than the Nifty, even at the word go. I mean, that was the issue on Friday, that the broader market was falling more than the large cap space, and that's how we have opened out today as well. Okay, let's take a look at some of the major movers and shakers. Let's actually pull up Bajaj Finance. I mean, to start off with, it was a big star and the big performer on Friday when the rest of the market was capitulating. And this morning it has actually opened up with some gains once again. Kotak Mahindra Bank is seeing some buying. NTPC, SBI Life. These are some of the counters that are flashing a little bit of green. But otherwise, it's a quiet start. It's a cautious start. Some of the IT names are seeing a bit of a rebound, trying to find their way back. You can see that on a TCS, on a Wipro for the time being. So let's see if this IT rebound lasts. On the flip side, you have names like Adani Ports, Bharti Airtel, Adani Enterprises, and some of the metal stocks like Hindalco. Hindalco was absolutely pummeled on Friday after the Q3 performance came out and the concerns with their US business, and there is still some negativity surrounding it this morning as well. But I want to quickly take a look at what's happening with the broker stocks. Angel One down 8% on my screen. Let's pull up these stocks. So Angel is down 8%. Let's see what the BSE share price is looking like now. My goodness, BSE is down 9% on my screen. Let's move on away from the Nifty for a bit and flash a lot of the capital market stocks, because that's where the concerns are, given what the RBI announced on Friday. Let's look at Motilal Oswal. It's down about 2.5% as I see it. So these are some of the names that are in focus right now. I'm just checking Grow and what Grow is doing. 4.5% lower on Grow. And like I said, Angel is the one that's really hit hard, 8% lower. And exchanges like BSE down about 9% as well. Check Motilal Oswal once again. It's still down about 2%. So yeah, now we should pull up BSE, Bombay Stock Exchange. That stock's down about 7-8% as well. So it's a bit of a tough start for the time being. What is the rest of the market doing? Let's look at some of the other names as well. On the mid-cap screen, some gains on a Bharat Forge, Lupin, Aurobindo Pharma, some gains on Dixon. These are on the upside. Now, if I talk about some of the decliners, then we'll pull up those names as well. Far more many stocks in red than green. Muthoot, by the way, is down another 3%. Some of the banks like Union Bank also slightly lower this morning as we start off. So these are some of the stocks in focus. We'll just pull up Religare. Religare is the other stock which is going through that demerger. I mean, you'll have Religare Finvest and Religare Enterprises, two separate listed entities now on the bourses. So that's another stock that is in news today. We should pull up Manappuram as well, because Manappuram is finally moving ahead with Bain acquiring a large chunk of equity in the company. Remember, Bain announced their 18% stock purchase in March of 25. It's been approved, and if they go ahead with the open offer, and if the entire open offer is subscribed, then they could be holding almost 42% of the company. Manappuram, we should pull up Manappuram Finance. Stocks down about 2% as we speak. So that's the overall opening. Cautious, but trying to fight back. The Nifty around 25,450. So there's been a buy at the lower level already that we're looking at for the time being. But yeah, watch for the financial space, watch for capital market stocks, because that's where the pain is really playing out. Okay, we'll keep getting you more rates as they stabilize, but it is right now time to welcome in our next guest on the show. And we have Pankaj Tibrewal joining in on the show this morning, founder and CIO at IKIGAI Asset Managers. Pankaj, good morning. What a pleasure to be speaking with you. Thank you for joining us on Money Control. It's the first time you and I are speaking on this platform, the digital platform, and glad you could make time for us.
Thank you, Survi. It's been a pleasure to be on the show.
Pankaj, so of course, we've been speaking with you right up to, the run up to the budget, just after that as well, trying to understand just how this market is positioned and placed. And the thing is, it's getting so much thrown at it. Every day there's one new thing. We thought the trade deal is an overhang and that is over. Then IT stocks, global IT meltdown came in as an overhang. This morning it's capital market stocks. So the thing is, there's so much news and noise in the market. And at an index level, there's overall 500-point range and the index continues to consolidate. So is this how it's going to be? More of this time consolidation, at least at the headline index level?
Yes, Surbi. I think what in September 2024 is both the price as well as time correction. On the headline indices, it's look like that we are 4-5% away. But if you look at the breadth of the market, the average median drawdown of BSE 500 stocks is about 28%. And there has been a sharp correction ranging between 20 to 70% across the market breadth. So I think it's been both time as well as absolute price correction across many stocks now. And I think finally what it boils down to, apart from the noise which we are seeing every day, is earnings. And I think the third quarter earnings just got over. 497 companies out of 500 have reported their results, and the 3 companies which are December ending will be reporting anytime in the next 2 weeks. And the results are very heartening. On the overall basis, results have actually grown by 16% on an adjusted PAT basis, because this time we have a labor code impact. And if we adjust for that, the profit growth is actually 16%. And what is more heartening is that after many, many quarters, you have seen the top line growth in double digit at about 11%. So I think both the numbers are very, very good. And if we segment that into market caps, large caps have seen about 14% earnings growth. Mid caps have seen about 19% earnings growth. And small caps, which have been a showstopper, have grown by 32% earnings growth. So I think broadly, the third quarter, which was not a great quarter because festive season had preponed to second, winter onset was late, and you had tariff issues for exporters. Despite of that, I think the earnings growth has been quite good. The channel feedbacks which we are getting as of from the ground, across sectors, we are seeing momentum being very strong. So me and our team have been on the ground for the last 25 days, speaking to companies, industry leaders, veterans. And the sense we are getting, apart from few where maybe the demand may be a little slow, but by and large, as the commentary has been that since mid of December, the trajectory of growth has picked up substantially. It is coming from domestic facing companies and sectors. For example, look at the volume growth of cement, look at the banking credit growth, and the flow of the new files and cases in banking. The commentary from steel and allied products very strong. Auto Ank and auto OEMs have talked about very strong recoveries across CV, tractors, passenger vehicles, two-wheelers, and that's sustaining even after the festive season. You talk about most of the value retailing guys, they are talking about very strong growth. So I think broad level commentary seems to be quite good. And January has gone up, and as per the conference calls also, for many companies to be very strong. So I believe if earnings starts to come through, markets will settle. And actually, to be honest with you, on a broader market basis, we are actually turning to be very positive now because the earnings momentum has started to pick up. And next 2-3 quarters, the base is on our side. And last year, don't forget, the monsoons were elongated. We had the wettest season in last many decades. So if the monsoon is normal this time, the base will be in our favor. And next 2-3 quarters seems to be set from a growth perspective. And if growth comes back, market beyond a point cannot ignore earnings. And I think that will also make sure that return of FI should start happening.
All right, that's a great optimistic note to start this conversation on, Pankaj. I'm feeling better. I'm feeling more inspired after hearing you. You know what? We have Mihir Vora also joining into this conversation because the earnings season is over and we wanted both of your perspectives and just how we're stacking up. So yeah, Mihir is there. I can see him as well. Mihir, good morning. Great to connect with both of you on Money Control. Thank you for joining in.
Certainly, always a pleasure.
So Mihir, Pankaj was just telling us, I don't know if you could hear him or not, but I'll bring you up to speed. Pankaj is sounding very optimistic after Q3 earnings. You heard him, yeah. So are you feeling as good, as optimistic after those Q3 numbers?
So absolutely. So as Pankaj mentioned, there have been more positive surprises than negatives, and margins seem to be holding up. So obviously, some amount of impact of the GST cuts in terms of demand increase, etc., has happened. So that is playing out, and only things we need to see the sustainability of the same in the next few quarters. But hopefully, once we've seen that once the cyclical bottom is formed, then the momentum does continue for a while. So there seems to be positivity in the overall momentum. The US markets are doing well; they are also going all ahead. So governments globally are still on that pump priming mode. They do not want the economies to falter, and as long as that is the mindset, you will see liquidity and all supporting the markets. So in general, given the fact that India was the worst performing market globally last year, significant underperformance. So that time correction and price correction and valuation correction has happened in the broader market. So to that extent, we are no longer expensive as a market. We are still the fastest growing large economy in the world. And the FII flows, even if they don't come in a big way, as long as they stop selling, that should be good enough for the markets because there is enough local liquidity. So I think we're starting off with a good base. Things like STT and today's RBI circular, etc., would obviously create short-term volatility. But in general, if you look at the fundamentals and valuations, we have a good base to start from.
Okay. But, I don't want to play spoil sport at all. And I'm very happy to note what both of you have said on earnings. But let me ask you a counter question. And Pankaj, this is some raise this in the market. That even if we get to say 12 to 13% earnings growth by FY27, or say 12 to 15%, let me broaden the range. Will it be enough to get FIIs back? Unless there is the so-called AI bubble bursts and they don't know what else to buy in Asia, what else to buy in the US. But if the AI trade continues, and what last week told us that the AI trade was only getting stronger. The software stocks were under pressure, but for instance, South Korean market still was doing well. So if the AI trade continues, then will 12 to 15% earnings really get the foreigners back? Let me ask both of you. Pankaj?
So Survi, you'll be surprised to know, I was looking at most of the large markets globally over the weekend. And the same question came to my mind that will 13 to 15% growth be sufficient enough to attract the FIs back into the country? And you'll be surprised to know with that number, we'll be among the top 5 fastest earnings growing market in the world. So it looks like that all the other markets are doing great, but there are base effect which will start playing out in many countries because last year a lot of them had a very strong earnings growth. So our sense is that 13 to 15% is very good, and also don't forget that market follows incremental change. The incremental change is that for the last 6 to 8 quarters, we have been in that high single digit growth for Nifty. And if we break out of that range, what market will focus on is the incremental change rather than absolute number. And that incremental change, in my view, is very positive. And the second part, which I would like to draw your attention is that now it's not Magnificent 7, it's just Magnificent 2. So only Nvidia and Google have been outperforming S&P 500. The rest of the 5 other names have been actually underperforming over the last 12 months. And you'll be surprised to know that now Microsoft on a 2-year basis is absolutely flat, zero return. So slowly and gradually, this AI trade, which was the core of the heart, I think starts to see some pick, which is starting to happen. And if that happens, Korea, Taiwan, China, which all have seen AI trade plays out, would see some kind of reversal and money flowing back to India. So that are the 2 things which I want to draw your attention.
No, that's a great point. And that's why the micros really help. That's a great point, Pankaj, and thanks for putting that on the table, that it's no longer the Magnificent 7, now it's the Magnificent 2. I'm going to remember that. Mihir, you were adding in. Go on.
Yes, and while you're right, the broad market earnings are expected to be 10-12%. That's at the large cap level. If you look at the consensus earnings for the mid cap index and the small cap index, they are closer to 17-20%, right? So there is ample scope for alpha generation and stock creation even within the broader market. So aggregates sometimes hide a lot of actual data. So if you break it up and go more granular, there is enough opportunity. So if the broad market just holds on, then also you can make decent absolute and relative alpha.
Okay. On AI itself, Mihir, let me start with you. I mean, that was this whole debacle of last week, right? The way IT stocks collapsed over here as if businesses are shutting down. I think there's just a lot of fear about the extent of disruption. There will be disruption, we know that. But I think there was complete chaos about how much disruption of the model itself. What's your sense? And would you be a buyer into Indian IT as this uncertainty plays out?
So structurally, we've been negative and underweight on the large cap IT companies, even before this AI scare came up. And the reason was that before COVID, they were already on a single digit growth path. We had 2-3 good years because there was COVID-linked IT spending. So there was a kind of a bunching up of spending. And if you see the last 1-2 years, again, they are back to the single-digit growth path. So structurally, this, IT services model is a single-digit growth model unless they do something different. So that's why when you talk about India as a fast-growing economy, you want to be in sectors which are going to grow much faster than single digits. So we've been underweight per se. This AI threat actually just accelerated a trend where they were just doing more of the same commodity work and not innovating. And this is what I think should be treated as a wake-up call. This is still a time where they can grab the opportunity and obviously build services around AI implementation. A lot of the companies are already talking about it, but it's going to be a long-run affair. So for the time being, we continue to be overweight. Of course, if there is opportunity where stocks really get oversold sentiment-wise, you can do some tactical allocation, but they need to really rethink the business model for us to get structurally bullish on the segment.
Okay, fair enough. Pankaj, what's your call? I mean, the wise men say that you have to buy businesses and good companies and good managements when there's total pandemonium, which is what's happening with IT. But I think the question right now is more on the business model and whether the current valuations are factoring in whatever this new business model is going to look like. Your thoughts?
So I'll take 2 minutes of yours. And you have heard my concerns over IT over the last 12 to 15 months. But
yes,
I think
absolutely.
the the recent, I think, pessimism is, I think, overdone. People are talking about terminal value. People are talking about other things. Let me just clear the air on that. And I always take a cue from history. Let's look at the last 25 years, Surbi. There have been, in my view, three instances where the same thought came to mind that the terminal value of IT companies are in question. First came 2000 dot-com crash, if you remember. And after the Y2K, people thought that Y2K is done. And what is the need now for IT companies? Because that transition has happened. And what will internet do? It will disrupt all the IT companies. Over the next 5-8 years, we saw the best time for IT companies because web became a biggest enabler for them. And a lot of implementation projects and everything happened. And that was a golden 2003 to 8 was a golden period for Indian IT companies. Then came 2012 to 2014, if you remember, cloud implementation. That everything will be migrating to cloud. AWS and Azure were going their revenues very, very fast. And there was a question that on maintenance, premises maintenance, everything will go off. What happened after 5-6 years? Cloud has become 30 to 40% revenue generator for most of the IT companies. Now then look at 2016 to 2018. SaaS and digital became the keyword buzzwords. And everybody said that the platform companies will take away business from the IT companies. What happened? That they also introduced platforms and became an implementer to those SaaS and digital companies. And they actually grew their revenues and formed a separate piece out of that. 2026, AI will disrupt the entire IT companies. Trust me not, AI will become as an enabler. You think about it. NVIDIA can generate chips. OpenAI can make LLMs. But at the enterprise level, to implement all these LLMs, you need guys who are system integrators. You can't just make a loose comment that the business model is gone. You may have lower people, higher productivity. That business alignment can happen, model can happen, but it's not that most of the IT companies will go out of business as you move ahead. And my view is that at some point of time, we have been earning underweight on the portfolios. I am getting a lot excited that the valuations are coming at a level where a lot of pessimism is getting set into, a lot of derating have happened, and companies which have demonstrated in this last 3-4 years of disruption that they still can grow double digit will be my preference of choice. So I don't think that I buy into that complete pessimism.
Okay, so Pankaj, the argument that was thrown out last week was that these new models, as the model evolves and, IT companies will be those enablers of AI, of the AI architecture. The counter argument that I got was that this new model will be closer to, say, utility services, because, and it will be at lower margins because you're only using AI to facilitate business. And therefore, you need to, it needs to quote and trade at a very different multiple than what Indian IT has traded in the past. So your thoughts on that argument? That they'll exist, but in a very different form. So therefore, lower multiples.
Absolutely, Surbi. I'm being in that camp completely, that the PEG. So I look at it in terms of PEG. So you were growing at 5-6%, the large cap IT companies, and still you were given 22-24 times multiple because of your huge cash generation which you were doing. But if growth is in question at some point of time in single digit only, the PEG will readjust. And few of the companies which in the mid cap can grow at a higher pace, they will deserve a premium which they have been in the last 3-4 year period. So I think it will not be go and buy the entire sector completely. I again repeat that it will be companies which embed the new model, new opportunities, and they will see growth faster than most of the sector. But I am saying that the argument last week had extended to such an extent that the terminal value is zero. And I go back to 4 years back. So if you remember, thermal power companies were assigned zero terminal value. Why? ESG, ESG, ESG. Now look at the companies which are making huge amount of, and after 4 years, the ESG is gone. Nobody talk about ESG now, and thermal power companies are still there and making huge amount of cash flows and PAT, because power is the need of the hour. So I am just saying that in this noise, you have to take a balanced view that is it completely destructive in the businesses, or companies will embed that AI as a part of their revenue generator and become a new source for them, because you need enterprises to use system integrators like IT companies for implementation. Trust me, if you are a company at say Network 18 and you want to develop AI, you can have two paths: hire a 10, 15 people of AI people, engineers, or have a system integrator come in your premises and embed those chat GPTs and others as a part of your overall database and try and find solution to it. Which option will you go by in the first 2-3 years? You will have system integrators coming in and use that as a tool, and that will be a revenue generators for system integrators. So I think
I can
at some
go on.
So at some point, in my view, I think the markets will balance out its view. I don't think it's either or. The answer lies somewhere in between, and we have to take a proper balanced call on this time of market. I think sentiments are completely negative. 11-12% IT index crack in this month itself is not small. And at some point, I believe that it will be a contrarian bet.
No, I take your point. I was just saying that personally, I'll be very happy when we have full AI integration at Network 18. I think some projects are already underway, because in our business, in the stock market news and information business, there's a sheer amount of data and noise and news and inputs and insights that if IT can make our lives a little simpler as market trackers and commentators, I'll take it with both hands. Absolutely will do. By the way, as we continue our conversation, should pull out some stocks which are moving around on news. NATCO has received the regulatory approval to market semaglutide here in India. That's the big weight loss drug, and the market's reacting to that. 8-9% up on NATCO Pharma. Signature Global has done a deal in Gurugram. It's up 6%. There is also, by the way, Torrent Pharma reacting to numbers quite well. There's K-Fintech. K-Fintech came out with numbers. It's up 4%. It's also one of the capital market stocks. And the numbers are pretty well received by the market, at least from the looks of it. Look at Force Motors. So I'm just calling out some of the mid-cap names which are managing a pretty good morning so far. So this is how it's looking out. Some of the IT names, Happiest Minds, for instance, it's recovered. It's up about 3.5% as we speak. Let me actually wrap this up with looking at the capital market space again. Angel One has cut its losses. Angel One was down 8% when the market opened up. Now it's down about 4% odd. BSE is still down about 6%. So yeah, those are some of the gainers. Now I'm talking about the losers, which are the capital market plays. Motilal is actually in the green now. Motilal was down to 2.5% when the market opened up. So, and then you have Grow. Grow also from about a 5-6% drop. Now it's about a 4% drop. BSE is still under pressure, though it's recovered from the opening gap down 7%. Okay, Mihir, let's talk about this. The capital market space. We keep hearing from most experts and most investors in the market that it's a ongoing story, financialization, so on and so forth. But the problem is the regulatory, minefield around it. You have now today's damages thanks to RBI. Then you have SEBI always coming out saying something or the other. Then we had the STT hit on budget day. So how are you looking at this whole capital market ecosystem? And within that, what sort of stocks, what kind of businesses would you still be interested in buying?
So, Surabhi, if you step back and look at the bigger picture, as you mentioned, there is no change, right? It's all about higher income levels, higher financialization, higher savings being channeled into the financial markets. So that structural story will always remain. What we are seeing in terms of actions, whether it's on the margin funding side or the prop trading side or the HFT issues that we saw, and then the STT increase, etc., is essentially the government and the regulator and the central banks also going along the learning curve. So we are an evolving economy. We have managed our exchanges and clearing systems very efficiently. We are amongst the most efficient settlement trading and settlement systems. So all those things are in place. But all said and done, because we are growing so fast and volumes have exploded in the last 4-5 years dramatically, whether it's on the MCX or on the stock exchanges, or whether in terms of demat account opening, broking account opening, there's been exponential growth in mutual fund folios. So the system is actually growing very fast, and you do see from time to time the regulators and the system learning, trying to identify risks and preemptively manage those risks rather than waiting for something to blow up and then acting. So what we are seeing is a process of learning from all participants, central bankers, etc., and that will create some short-term volatility, but the structural story does not change. Volumes ultimately will go up, savings will ultimately grow up, and we will see growth in this segment in the medium term.
So, coming to final thoughts, gentlemen, both of you are sounding reasonably optimistic about everything, including IT. Like Pankaj just, made a strong argument with very, very specific reasoning why he's looking at IT. So, what's the bottom line? Is the market heading higher? Mihir?
If the FIS stops selling, the market's going higher. And I think there's a good case for them to stop selling, especially after all the trade deals that we've signed and the results, the kind of results that are coming in. And the fact that probably we are at the peak of the AI hype, and AI hype should reduce going forward. Then our standing as we just discussed, as the fastest growing large economy in the world was there before. We are still there. So things should stabilize very soon.
And I know I'm pushing you, and I know you won't like it, Mihir, but by when? I mean, thematically, I completely agree with you. And both of you have explained, the FIs have to stop selling. This AI trade at some point will fizzle out. But it could happen 6 months later. It could happen 12 months later. It could start happening now. The question is, when?
The probability of it happening
Mihir?
sooner rather than later is higher. Because as you know, the money printing game is still on. So globally, risk on is a thing, right? So as long as we have that situation, you will see money flowing from one asset class to another in a sequential manner. So last year it was AI, and then it was gold and silver and precious metals, and then you also at the second half of the year you saw money flowing into China and emerging markets also. So India is a part of the emerging markets. For all those geopolitical etc. reasons and the trade deal not happening, we were kind of left out in the sidelines. But we are still part of the emerging markets where money is coming in.
So, quick 2 last questions to both of you, and one each. Mihir, my question to you is, what would you say to investors who have been shying away from equity funds and rushing over to gold and silver ETFs? By the way, there is a regulatory change for ETFs as well, and we'll discuss that after this conversation. But what would your advice be? Because equity investors have almost gotten tired of low return or no return, and they're chasing precious metals. What would you say to them?
All I would say is that, look, 80% of the demat accounts have been opened in the last 6 years. And we've had a dream run for the first 5 of those 6 years. Dream runs don't last forever, so please moderate your expectations from equities. The 20%, 25% CAGR is not the norm. 10 to 13% is more like the norm. 10 to 14% if you go for mid caps and small caps, etc. That's more likely a realistic expectations. But similarly, don't also expect those kind of returns in gold and silver that you made last year. So there has to be balance.
100% plus, right?
There's a place for gold and silver in asset allocation. There's a place for equities. There's a place for fixed income. Stick to your long-term asset allocation.
Speaking of gold and silver, I'll make this my final question to Pankaj. Pankaj, I know you were looking at metals favorably. Now, I don't know if they were the shiny metals, the gold silver types, or the industrial metals. Silver is both actually, both shiny and industrial. But leave us with final thoughts. IT, you've already called out that it makes sense to look at, building some thematic long-term positions there. What else? A specific call on metals and something else. I mean, that really stands out for you in terms of sectors and themes to study further in this market now.
So I believe that commodities still remains, I think, important sector to be part of your portfolio. And the reason I'm saying so is that over the last many years, if you look at geopolitical landscape is changing now, and people are using mineral and resources to use it as a negotiation tactic. We have seen by Venezuela, Greenland. So I think commodities should be part, hard assets should be part. My bigger macro thought is globally inflation is coming back very strongly. Be prepared for it. I think the world has grown in the last 15 years valuing Max 7, software companies, AI companies. people have forgotten how to value a commodity company. And trust me not, hardly when you look at the street, there are hardly any good commodity analysts left because nobody used to talk to them. So they have all shifted their, core sectors. So I think this time around, over the next 3 to 5 years, I think commodities will be really a very valuable part of your portfolio. I think please look at it very carefully. The second part is, I think chemicals has started to make some sense now. I believe that the China import data has started to slow down. And the anti-involution policy, which I believe is a very, very important policy step in China, please don't ignore that. Our broader thought is that over the next 3, 4 years, China will vacate the low-end manufacturing and focus more on the high-end AI and the tech part. And that means that commodities and chemicals, which are very important portion of Chinese manufacturing, starts to at margin come down on competitive intensity. And that's good news for Indian specialty manufacturers and bulk manufacturers. It's early days, but keep it as a contra trade for this year. The way we spoke about commodities as a contra trade for the start of the last year, I think we are talking about chemicals as a commodity trade for this year. And finally, I think the leadership will change in the market. I think consumption will make a comeback very fast, not the staples, but the discretionary. And the early signs of revival are very, very strong. You saw how the QSR company spoke about after a long time positive January, and trends been increasing, value retailing doing extremely well, and many other factors are at play. Also, one global factor, Survi, is that for the first time, Walmart has entered into a $1 trillion club. Don't ignore that, because whenever a large company enters into the $1 trillion club, it gets attention for the entire ecosystem globally. Look at the way 5, 7 years back when companies started acting into the IT and the AI side on the $1 trillion club. This is the first retailing company globally which has entered into a $1 trillion club. So I think these are the few things which are making me a little sure that maybe consumption could make a bounce back this year, and leadership may change from first it was IT to banking, now probably to consumption at some point of time, and consumer discretionary will be my pick.
That's a very, very interesting observation, Pankaj. Again, thank you for putting that on the table, and we'll remember that absolutely. We all remember how Nvidia first started hitting those $1 trillion headlines, and the rest is history. Let's see if consumer stocks go through that as well, because they've had a prolonged period of pain, many, many years. So Pankaj's pick, obviously look at IT, look at commodities, look at some of the specialty chemical stocks, and perhaps consumer plays as well. It's very, very helpful guidance over there. Thank you, gentlemen. Great conversation. Thank you both. You made a Monday morning, and I think viewers will take a lot of solid points away from this discussion. So thanks for joining in. Wish you both a fantastic Monday and a great week ahead. Thank you.
Thank you, Mihir. Thank you. Thank you. Bye. Thank you.
All right. Thanks very much. Well, there you have it. Two big fundamental voices on the market on how you can be looking at, your portfolios and focus on the real, focus on what is actual rather than just the noise and headlines. And the headlines will always come and go, and we are in the business of news, so the headlines will always be coming through. I just want to acknowledge some comments that came in from our viewers, by the way. Alex was saying that I'm wondering why people are worried about Indian IT giants. As the guest said, that India is in the young age of AI evolving. If AI is a bubble, let the bubble burst, and after that we can invest. Okay, so that's what he's saying. Sri is talking about HCL Tech. Sri, we don't have a technical analyst with us right now, but maybe we'll take up your query tomorrow on HCL Tech. Most of the IT stocks actually have been recovering. Before we introduce our next guest, let's actually take stock of a lot of the brokerage calls that have come in today. On a lot of stocks where earnings came out, a lot of stocks where news announcements came out. So check out what the brokers are calling for today, and we'll be back with another conversation on ETFs. Okay, all right. Let's move on to our next topic of discussion. Before actually we move on, I just want to point out that the market is again a little wobbly, and that recovery from the lows is not quite lasting. And the Nifty's turned completely flat. There's a little bit of a tinge of red on the index, and the fight continues around the 25,450 mark. So keep an eye out on the market. Still a little tentative. However, the discussion that we are putting the spotlight on now is new regulations which are being proposed for ETFs, exchange traded funds. And these are regulations that SEBI proposed at the end of trading hours on Friday. So the announcement came out on Friday evening. And this is what SEBI said, and this quote was very, very important, so I thought we'll put it up for you on the screen. SEBI went on to say that considering the recent high volatility during the last week of January 2026, specifically in gold and silver ETFs, in the prices in the domestic international market, the existing price bands for gold and silver ETFs based on the T-2 NAV system had become inadequate to ensure alignment of their market prices with the underlying assets. So SEBI took note of this. And now SEBI is proposing a change. What is exactly the market regulator saying? The market regulator is saying that the current system on which price bands are set for ETFs in general, and particularly gold and silver ETFs, that system is not enough to curb volatility or to have a real reflection of the price of the underlying. So an exchange traded fund will be trading either on an underlying equity index or an underlying debt index, or it could be on an underlying commodity like gold and silver. SEBI is saying that the current system does not adequately reflect the fluctuation in the underlying commodity or equity or fixed income instrument. So there is a need to change this. And now SEBI is talking about price bands which will limit this intraday volatility, because we remember back in January, gold and silver ETFs were becoming so volatile that they would move 10-15% up and down on a single day, catching investors off guard. So there is a new system that is being proposed, and that's exactly what we are going to discuss with our next guest. Siddharth Srivastava, who is head of ETF products at Mirae Asset Mutual Fund, joining in. Siddharth, good morning. Thank you so much for joining us on Money Control today. Good to have you on the show.
Thank you so much, Surbhi, for having me on the show.
Okay, now your challenge, Siddharth, is going to be to make this as simple as possible, because this is fairly technical, right? The kind of overhaul that the regulator is promising. So what SEBI is essentially saying is that ETFs took the T-2 or the trading day or that particular day, -2, 2 days prior price as the base price to decide how much of volatility or how much of price change is admissible or possible in a day. And that is going to change now, isn't it, Siddharth?
Yeah, so I'll just put the problem statement first, that what was the issue. So for all the equities, your normal stocks, the circuit limit is decided based on T-1 closing. So if you're sitting on Wednesday, it is dependent on Tuesday closing. Now ETFs declare their NAV by 11 o'clock in the night, and that was too late for the exchanges to base their circuits based on T-1 declared NAV. So they used to consider T-2. So which is for Wednesday circuit breakers were decided based on Monday declared NAV for ETFs. Now what issue this created was that ultimately there was a lag of 1 day. So there's volatility on Tuesday. Your circuit breakers were not based on ideal prices or practical prices. So I think that is what SEBI is basically suggesting, that let's make circuits more practical, relevant, and based on latest information rather than T-2 information.
Absolutely. So that's one part of the change. One part is that at what base do you start calculating the price change itself? The second part is deciding how much price change is okay in a day or not. So the first part we've understood that the base price has to be now T-1 and not T-2. So it's more truly reflective of what the price change is like, which is what we have in stocks. I mean, on stocks or on an equity index, when we talk about a price change and when the circuit filter comes in place, it's based on the closing of the previous session. So that is what is going to be applicable to ETFs as well. Now let's talk about the price bands themselves, Siddharth. So ETFs, most ETFs had a 20% plus minus 20% up or 20% down. That kind of a price band up until now, right?
Absolutely. So apart from liquid ETFs, all the other ETFs basically have a price band of plus minus 20%, which is at times not aligned with what is happening with the underlying asset class. So for example, while MCX futures may hit a circuit at 6% itself, the ETFs continue to trade. So that is again one discrepancy or mismatch which exist. And I think SEBI is now looking at sorts of aligning it with what is happening in the underlying asset class. So if Nifty is as Nifty index, if it moves by 10%, then it has a cooling off period. So does MCX gold futures. What SEBI is suggesting is probably align ETF circuits as per that.
And that would make so much of sense, Siddharth, wouldn't it? Because, and this is a question, actually, I did several shows on this last week as well, exactly to discuss this whole ETF volatility. And ETFs are becoming very center stage products now. I mean, look at the amount of money that was flowing into gold and silver ETFs in January. So, for the benefit of viewers, just explaining this to you, that what was happening was that the underlying metal, gold or silver, maybe it's moving up 5, 6, 7% up and down, up or down. But the price of the ETF, which depends on the local demand and supply here in India, that perhaps would move up by 12%, 15%, again up or down. So it was not mirroring the fluctuation in the underlying price. So now, Siddharth, I think for gold and silver, what is being suggested is an initial circuit of 6%, right? And then you can go up to 20%. Just explain that to us.
So what MCX typically does is there's an initial circuit of 6%, then cooling off for 15 minutes, and then additional movement of 3% is allowed. So aggregate circuit is at the 9%, and then exchange can decide to further increase it by 3% each. Having said that, we also have to realize that we are talking about futures and then trying to fix bands for ETFs which are based on spot prices. So your movement in futures may not always be correlated with spot prices. As you know, there might be inbuilt premium discount, it may be trading at backwardation, or you are seeing a contango. So I think SEBI has to think this through in much detail so that there's a distinction between what is allowed to move in the spot and what is allowed to move in futures. Also, SEBI has to, apart from gold and silver, think through for international ETFs as well, because while issue of gold and silver has propped up now, international ETFs have been trading at significant premium since quite a while. So that is also one piece which SEBI should focus on.
So that I was just coming to that. I'm glad you brought it up. Just expand on that. Because on the equity side, there are a lot of ETF products that are investing in global equity markets, right? They could be investing on the Nasdaq, they could be investing on China, so on and so forth. So what was the volatility in some of these products? And now what is being proposed? Because again, I think instead of just the daily cap of 20% up or down, now even here, SEBI is saying that do an interim cap, an initial sort of price band of 10%, right?
So, in case of international ETFs, I think more digging is required, because see, what can also happen is that there will be misalignment of non-business days. There can be a period when Indian markets are off for 2 days and your China market is open or US market is open. If you base your circuits of what happened when India was last working, can again create an issue. So we have to, if we want to create a robust rules, then difference between non-business days between exchanges should also be considered. And same thing can happen on gold and silver also, that your international markets are active and your domestic market is closed.
That's true. That's a fair point. That then how do you account for the changes? Because many of these commodities and some of these equity markets are globally trading while we might be closed for a holiday. Now, I just want to remind viewers that this is still at a proposal stage. This is a discussion paper that the regulator has put out. It's not the final set of rules, and we need to see how those rules evolve. So, Siddharth, then let me make that my final question. What do you think is the best way forward, both for some of these global ETFs, for the commodity ETFs, because these products are growing in popularity and adoption?
Absolutely. I think there needs to be a different set of rules for equity, separate for commodities. And to be honest, this has come late last week. So we have to think it through, and there has to be hierarchy also, that if X is not available, then move to Y. SEBI has suggested that you can look at closing price or T-1 NAV or indicative NAV, which is also referred as INAV, to decide on circuits. But then there has to be also exceptions placed in case of exchange holidays in domestic or international markets, etc. So I think what we'll propose is a more robust mechanism, water flow mechanism, where all these issues are taken care of. And SEBI has asked for opinion, and will definitely, and the industry will definitely give the opinion so that the rules are set as robust as possible.
Okay. All right, Siddharth, thank you very much for a quick heads up. Helps us understand the issue at hand and the way regulation is evolving around it. So it'll be important for investors to track this, especially if you're looking at ETF products. Make sure that you keep tracking these developments till we get to the final regulations. Thank you so much, Siddharth, for joining in. You have a great day.
Certainly.
Thank you. Okay. Well, as we wind down on this edition of Opening Bell, let's take a look at the Nifty once again. The Nifty has managed to hold its head above water. Right now, the index has managed a level of around 25,500. So flattish trends, but there is a bit of a fight back that is underway. The financial services index, the bank index, actually, Nifty Bank, is the one that's really trying to, fight for the bulls. The mid-cap index has also recovered from the lows. The mid-cap index opened about 0.5% lower, but now there's a recovery. That's the Nifty for you. Looking much, much better now, above the 25,530 mark. Let's pull up the mid-cap index as well. Mid-cap and small-cap, both of them are flat at this point in time, but it's financials and banking, which is where the green is really showing up, at least at this juncture. And keep an eye out on, of course, the capital market stocks, because many of them are still flashing red. All right, with that, it's curtains on this edition of the show. Thank you so much for watching. But do remember, we'll keep getting you more news and updates from the markets throughout the day. Thank you for being with us on Money Control.